We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. This episode is brought to you by the Investments and Wealth Institute and sponsored by John Hancock Investment Management. Today's guest is Matthew Miskin, CFA. He is the co-chief investment strategist with John Hancock, and he'll discuss with us the trend toward passive investing and various asset classes. So welcome to the podcast, Matt.
Thanks for having me, Bob.
It's a pleasure. So before we get started, do you mind giving our listeners a brief overview of yourself and your background?
Yeah, sure thing. So I have been in the industry for 15 years now. I started as an analyst back in 2009, 2008 in a major broker dealer. Did that for about 5 years, doing asset allocation and manager selection and recommended lists for a broker dealer. And I've been at John Hancock Investments for investment management for 6 years now, doing primarily the market outlook, market intelligence. It's our flagship quarterly piece. We cover 17 different asset classes. We do multi-asset perspective and a lot of research around that. We get to tap the intellectual capital of our asset managers. We've got a wide range of macro research providers that help us in determining views. And our track record, we really are trying to be accountable for these views over time. And our track record has been relatively successful. We've done okay in our biases over time, and we're looking to keep that up as we go into the end of 2020 and into 2021.
So part of our discussion today will focus on the value versus growth stock discussion. So let's start there about the catalysts for value as well as the environment that allows growth to continue to outperform.
Yeah, so the macro regime is one that we really look at as that driver between value and growth. And we've been in a macro regime that has been one of lower growth, lower inflation, and an incredibly supportive central bank, whether it's the Fed or really any central bank globally. And COVID in particular, and what has happened to the global economy has actually accelerated the growth outperformance. In fact, the last 12 months through September had the second largest underperformance of the last 40 years of value versus growth of about negative 42%. And really to us, this macro regime of slower growth, lower inflation is being, compounded by COVID. But if the world reopens and in a post-COVID world, you could have a very different macro regime. And one thing we're looking at right now in particular is China. So China has gotten a bit further past the virus. They're not seeing as many cases. And if you read up on what's happening in China right now, tourism is booming. You're just seeing a complete, comeback in terms of economic activity and people coming out and doing things. And in that kind of world, we do believe a macro regime shift would happen if that was globally. If you finally got to do whatever your favorite thing was to do or travel, that kind of economic activity would likely result in a higher growth profile, higher inflation. And in that case, likely a switch in performance where value would then take leadership over from growth.
So our audience are investment advisors who deal with endowments and pension plans and retail clients. And for many years, these advisors have had to explain why they might be investing in value versus growth or the combination thereof, and having to explain perhaps the underperformance over all these years. Any thoughts about the performance of the value versus growth stocks, and what advisors might be saying to their clients given your outlook?
Yeah, I mean, the first thing is that it has certainly been a story of a few key stocks that have been driving the growth outperformance and outperformance of kind of these few stocks have really left behind the broader market. And, you know, you can look at as a percentage of the overall S&P 500, the top 5 names. You know, they're about just over 20% of the S&P 500. That dwarfs what happened in the 2000 period, a much lower percentage in terms of the overall market capitalization. And, you know, these top 5 names are all tech or tech related, and they're high growth names. But, you know, as of late, you've started to see that peak out a bit, where the other 495 names of the S&P 500 have started to catch up a bit relative to those top 5 names. So that dispersion is one that I think has really been a big driver of the growth risk value outperformance, is those key names. But, you know, if the economy does come back, if you see a broadening of the market, which we are starting to see some indications of, that wedge or kind of, you know, the magnitude of that outperformance could certainly start to stall out at a minimum, which we are seeing, and even revert. So that's one of the key things we would think about in terms of attribution. And one of the potential catalysts is if the rest of the market could catch up to those top 5 names, value would very likely start to catch up on growth.
Mm. And just by way of history, the underperformance, you've done some work on that. I mean, it has been significant.
That's right. If you do a scatter plot of just, you know, you look at all the different rolling 12-month periods, even over the last 40 years. So -42, -43% in September, in August on a trailing 12-month basis, where the 2 underperformant periods there, it dwarfs basically everything else over the last 40 years in terms of the magnitude of that underperformance. You know, if you look at the rest of the data points, this is really an extreme outlier. And, you know, it's not necessarily that you have to be fully a reversion of the mean type investor or have that kind of thought process, but it does, you know, statistically look like an extreme outlier. And if you think about a more normalized world that could be in the future, that, you know, it's more likely in our view that a more average or a less pronounced outperformance is more likely in the future. And for that to happen, you need catch up. And we think that's what's in the cards, is that value will catch up to growth because of that extreme, statistically, outlier in this underperformance streak.
Right. I imagine patience is the key word here.
Yes. And, you know, it's funny, we've thought a lot about what's the catalyst, you know, what's the catalyst to have this happen? And one that we often think about is, well, we'd like to see rising interest rates. Well, you know, if you're going to wait for rising interest rates, that's going to take a lot of patience. So we see the Fed likely on hold all the way to 2023. That's what the FOMC is projected. We think it could be even later, it could be even 2025, but the world's changing. It's really hard to say that when, you know, if the economy reopens, that the Fed would have the same projection in interest rates. The other thing that's important, and this is a study we just did, we looked at outperformance of value versus growth and overlaid that with changes to the Fed funds rate. We were expecting to see value outperform growth consistently when the Fed funds rate rose, and vice versa. So growth outperforming value when the Fed funds rate fell, because, you know, that's the number one thesis and catalyst people have is, you know, you need rising interest rates for value to outperform growth. Well, when we did this regression analysis, we actually found that the R squared, or regression, between the outperformance of value versus growth and changes in the Fed funds rate is basically 0. Meaning there's basically no statistical relationship between changes in the Fed funds rate and value outperforming growth. In our view, again, it goes back to the macro regime. And there's also an element of when things get too stretched one way versus the other, like 2000, the tech bubble, even though there was cutting of interest rates post the tech bubble, value still outperformed growth after that. And, when we were talking about those top 5 names being stretched versus the overall market, it's a similar setup. So we don't believe that you necessarily need rising interest rates or have to wait for rising interest rates for value outperform growth. Statistically speaking, it suggests that that isn't the catalyst. We believe that once we're post-COVID, that's the real catalyst to watch for in a more sustained change in the macro regime for value to outperform.
Yeah. So obviously this is a bit of, it's contrary to conventional wisdom. Every article that you Google on the internet will tell you that rising rates help and falling rates hurt. So this is a bit of a myth buster from your perspective.
That's exactly right. And, I think one of the things that had been the biggest components of value investing was financials. So the financial sector was it's still significant, but it was much more significant in even the late, 2008 or into the end of the last cycle. Financials were, meaningful part of the value complex. But what we've seen just because of market capitalization changes, healthcare is becoming a bigger sector within the value complex. Consumer staples, other sectors are starting to come up in the value side. And financials are becoming even less, not that they're still relevant, but less of a singular force, if you will, in value. And so we think, if anything, rising rates are not going to be that key catalyst. We think value can outperform on other merits. Earnings coming back, just broadly speaking across sectors. Again, concentration being so steady in growth, if that breaks down, these are other key elements that are probably more impactful today than rising rates.
Right. So also follow up, when you looked at this study and also in light of your views about where value could go, do you delineate between large, mid, small, U.S. versus, say, international?
We do. So when we look at large, mid, and small, we actually see the best opportunities in large and mid today. The theme that we have across our outlook right now in market intelligence is to have a quality bias. And really that's just because we do believe there's still a shaky backdrop as it relates to the global economy and COVID. So we want to have businesses with good profitability, better return on equity, better balance sheets. Small cap companies, in our view, still have an uphill battle here. They don't have the access to capital markets as the mid and large cap stocks. So we do like mid and large a bit more than small. And then as it relates to US versus international, we believe that you could be in the process right now of a bit of a decoupling in the US economic trajectory versus international. We're seeing the US economy chugging along here into the fourth quarter, a bit stronger than Europe and Japan and some of the other major countries abroad. And also we're seeing US value stocks have a higher return on equity than international value stocks. And we believe that there's more risk of solvency issues, meaning, European banks, European financials struggling with negative interest rates, struggling with never really cleaning themselves up as much as US counterparts. So we believe there's better quality value, and that intersection is in essence our best ideas right now, quality and value. And that leads you to the US versus international. So that bias we think is a real key component as we look out the next 12 to 18 months.
So do you want to turn our attention to active versus passive investing? Is there anything left to say about value versus growth?
No, the active versus passive one, I think it goes back to those top 5 names doing so much in terms of the index composition and doing so much as it relates to the attribution of the performance. So if you get a broadening of the market and smaller cap stocks and even mid cap stocks do better, and You step away from those top 5 names, I think that really opens up better opportunities for more of an active approach. And it doesn't have to be, full active. It can be tilts on factors. Other than momentum has been the factor this year. And momentum is the factor of whatever has done well the last 6-12 months, you buy it. That factor can have, the reason we don't like that factor is it can whipsaw very fast. So it can do very well and you can chase that return, and then it can fall very fast and momentum gets in and out of favor. If that momentum factor breaks down, it opens up value, it opens up size, it opens up quality, high dividend, even low vol. So it opens up other factors, and then that to us opens up the key to more active managers being able to outperform. If you believe that the top 5 stocks might have peaked as they're waiting in the S&P 500, which I have a chart that suggests that might be the case, then that should mean that other opportunities outside of a market capitalization weighted index are waiting to become better performers.
So what options do investors have that want to shy away from the high cost of traditional active management, but are concerned with valuations and concentration risks that are becoming more prevalent? Maybe you answered that to a degree here already.
Yeah, no, it's, So there's factors, there's ways to combine those factors. There's ways to find lower cost, but also be able to still outperform, grind out outperformance. And it's trying to optimize the factors. Again, we would step away from momentum and find other things. And market cap weighted is in essence a momentum factor. So when you talk about the S&P 500, every day it buys whatever stocks were up, or in terms of the market cap went up, and it sells the stuff that the market cap went down. And that's a momentum play. As that momentum factor starts to fall, again, it opens up other plays, and then it's how you combine those, the thought process around it, and it's optimizing the cost of that with the return profile you're looking for, the excess returns. So there are some pretty attractive ways to get that done.
Yeah. So this might be a bit off script. I'll let you be the judge of that. But obviously, there's a lot of money flowing into S&P 500 index funds through 401k plans by virtue of plan participants choosing that as their option. I mean, is that a counterbalancing activity that needs to be reckoned with as you think about the opportunities that arise?
I think the overall data we've seen in terms of flows is, and this isn't just for 401k participants, but this is across ETFs, mutual funds, you name it. The number one investment has been money markets. So money markets have taken in over $800 billion this year, dwarfing, US equities are in outflows, significant outflows. So investors, if they're using a mutual fund or an ETF, have been selling stocks and then been buying cash. In our view, that has likely peaked in terms of that, dispersion, if you will. So cash balances, the money market net flows have actually started to come down a bit. And we believe that US equities could be seeing greater inflows. If the product is the S&P 500 or something else, in our view, the retail investor, and I think there's been more blurring in institutional versus retail now to every investor. I think it could create actually a broadening in the market regardless, because if it's not cash and it's not bonds, if they're starting to go back into equities more broadly, I think that could open it up. And so to me, it's just about the broader asset allocation decisions being so out of whack. And if that turns, I think that's a wave that could really actually last. And I think it could mean a broadening in the market overall.
Any other thoughts about the active versus passive debate?
I think the one, thing that we're looking at too is mid and small coming back. And, it's been, mid and small, similar to value versus growth, have seen underperformance. And, you just look at, the last couple of weeks even, and it's a shorter window, fair enough. But you started to see small caps in the last 10 days. I think they're up 10%. Mid caps have also seen a strong bid. And, one of the things about a bull market that has been constructive is that it doesn't rely on 5 stocks. That's not a sustainable bull market. You need these rotations, and in these rotations, it's opening up other opportunities for active investors. So, as these things turn, it could very well open up new opportunities for active, and that could be a huge regime shift if that is something that is a longer term trend developing.
Mm. So before we wrap up, I'd like to make mention that you often write on the John Hancock site your some thoughts on a regular basis. And if it's okay, the last piece I saw was published in August about investing for the next presidential cycle and how macro trumps policy. Is it okay to chat about that?
Sure thing. Yeah. So, really, we just looked at the Obama administration, what did well, what did not do well. We wanted to, in essence, bust the myth or look into the hypothesis that the president would actually influence the intramarket performance out there. So what sectors do well, or style, or cap factors. And we looked at the Obama administration's second term versus the Trump administration over the last 4 years. And what was really interesting to us was that the performance of within the market, so sector, style, cap, was remarkably similar. So tech was the best performing sector, both under Obama and Trump. The worst performing sector was energy under Obama and Trump. Similar leadership in terms of style, cap, so on and so forth. So it goes back to that, same thing we were talking about, that the macro regime. So we looked at the average growth profile under the Obama administration. It was about, real GDP was about 2%. Inflation was just under that of 2%. Under the Trump administration, on average, similar GDP, similar inflation. We need, if you want to see a change in the leadership profile of the market, it's not necessarily a new president. In fact, we would say a new president, or if there is or is not change in the president, we don't think that's going to change the macro regime. When we get through COVID, that to us will change the macro regime. And really, that's the number one thing we're focused on as it relates to a catalyst to change and see this huge rotation that could really be developing over the next several years.
Well, I want to give you an opportunity to maybe talk about anything that we haven't chatted about that you think would be worthwhile, or anything that we've talked about that you'd like to reemphasize before we wrap up.
The number one thing, again, we're looking at, other than what we kind of discussed, I think we hit it on a little bit, is this U.S. versus non-U.S. bias. And I would just, the dollar has been weakening, which is helping the international side. And that's a real big deal. If the dollar continues to weaken, that's something to consider for the international side. But what we're seeing in terms of economic growth in the macro landscape is that the U.S. may be doing better through this. Part of it's the stimulus packages have been far superior in the U.S. or larger in scale than internationally. Part of it is, the economy is built more with a digital and technology advantage than much of the rest of the world. But, you kind of put these pieces together. I think the U.S. versus non-U.S. bias is one that we're really emphasizing here into the close of this year. And we want to make sure that, whether it's growth or value, we want to have U.S. assets that represent that. So U.S. mid, U.S. large value, U.S. large growth, and sacrificing those allocations or putting those allocations intact from the international developed side is really our positioning across global equities to grind out outperformance in a broader balanced portfolio.
All right. Well, Matt, I want to thank you for sharing your knowledge and about this topic. It's much appreciated.
Anytime, Bob. Thank you.
Thank you. Thank you for listening to this episode of the Exceptional Advisor podcast series. This episode is brought to you by the Investments and Wealth Institute and sponsored by John Hancock Investment Management. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. And don't miss the upcoming Exceptional Advisor webinar on building better outcomes, October 22nd, 4:30 to 5:30 p.m. Eastern Time, with featured speaker John Bryson, Head of Investment Consulting at John Hancock Investment Management. Learn more about this complimentary webinar and register for it by visiting investmentsandwealth.org/building better outcomes. The Institute stands ready to help you as you navigate these turbulent times with new resources, research, programs, accommodations for candidates, and certificates. For more details on resources available, visit www.investmentsandwealth.org. This podcast took place on October 8th, 2020, and is brought to you by John Hancock Investment Management Distributors, LLC. The views and opinions expressed in this podcast are those of the speaker at the time of the recording and are subject to change as market and other conditions warrant. This podcast is for informational purposes only and is not intended to be, nor shall it be interpreted or construed as a recommendation or providing advice, impartial or otherwise, regarding any specific product or security. Any economic or market performance is historical and is not indicative of future results. Investing involves risks, including